Okay, welcome again to another edition of the lecture. Today, this is the second lesson on income tax, IAS 12. And we continue by looking at the disclosure requirement, like I've said. Earlier, we have looked into the definition of what current tax is. I told you the scope of IAS 12 mainly covered out of the current tax and then deferred taxes. And then, we look at so many other definitions within that scope. And so our concentration, like I said, under IS 12 is on entities' income taxes. And then we look at the current tax as well as the deferred tax. So if you look at the first lesson, please, you can go back, watch, and look at it. Please, you can speak to me when you are not clear. Just send me voice notes, private chat me. That's what I would like. Private chat me. Let me know if you are not clear on certain area, what would the questions you need to ask and the like. So, in this second session, we continue by looking at the disclosure. I just summarize some few key ones. There are plenty of the things that you have to disclose. Like I've said, disclosure only simply means your level of compliance with the adoption of policies and the level of compliance. So, what exactly did you do? How did you do it? What did you adjusted and the like? So, majorly, what you should be concerned about when you are writing for disclosure should be what are the current disclosures will speak about the current year tax expenses that were computed. And then you should be able to state number two, every adjustment that are made. And then number three, you should be able to look at the amount of deferred tax income or liability as it were that you are carrying in the financial statement. You should be able to state it. Why the need for this disclosure? It is important for you to disclose because so many people may not go through the body of your financial statement. Some will just go to the notes of the account and read whatever it is that you have put there. So disclosure, you must always disclose every of these details. And number fourth one should be the amount of benefit that you derive from the tax regime. Talking about the tax allowances that you enjoy, you must be able to state them. You also need to state the amount of tax on discontinued operation, the amount of tax on discontinued operation. For instance, maybe you have four divisions, but you discontinue operation of one of them. You'll be able to tell us the amount of taxes that emanated in terms of that you are not going to pay, rather henceforth from those discontinued operations. And so that is that for that. Like I said, income tax is one of the standard that they test every now and then, directly or indirectly. So whatever it is that they are asking you, it can be more than calculate the current year tax, calculate deferred tax, explain deferred tax, explain current tax, and the likes and the likes. So let's really look at this example in illustration one, and then it will help us to and guide us to know what exactly we are to do. Now let's read illustration one. The current year tax provision for Tinubu Article PLC is to be taken as 30% of total taxable profit. The profit for the year is 30 million with depreciation, fines, and impairment of 2 million, 3 million, and 4 million also charged respectively before arriving at the profit. Last year tax provision was 5 million, but the actual payment was 4 million. The tax base of plant and equipment is 100 million, whereas the current amount as at date, 3 years after purchase of the asset, is 120 million. Current year deferred tax liability is 2 million. Therefore, determine the income tax will be deducted from the profit of the current year. So, what you are to do here is also determine the current year profit. And like I have said earlier, the how to calculate this is determine what is the current year provision. The current year provision hard under provision. That's what I said. Hard under provision. Hard decrease in deferred tax. Hard increase in deferred tax. Less decrease in deferred tax. And less over provision. That is the formula or how to calculate it. So quickly, I also have some other past questions here that I want us to look to. That's why I'm trying to rush through so that we can look at everything together. These are past questions. These are the 3 main years that they have said these questions since 2016, between 2015 to 2022. Yes, these are the 3 main years that they set this question. And then this question 6 was set in May 2018. And then this question 3 was set in, I think, November 2018 or so. And then this question 2 was set in, I think, November 2021, if I'm not mistaken. So, if you are writing in this, if you are writing in this 2024 May, I think likely I want to assume that you may come across income taxes. So don't play with it. It's a very simple thing that you can take your look at this question. For instance, I wrote 20 marks. This one 20 marks. The other one is 15 marks. Just take it and enjoy yourself. But quickly, let's look at the solution of the one we have read, and then we'll come back to these past questions. And the solution is very simple. Number one is to determine the current year tax. And so, to determine the current year tax, let's go to the workings. We were told that the taxable profit, the current year profit is 30 million. And but there are adjustments that need to be made for you before you can charge your tax. Because, for instance, depreciation is not an allowable expenses. Fines is not an allowable expenses. Impairment is not an allowable expenses. So you have to add them back to the profit. And that's what we have just done here. We add them back, and then the total that we got, 2 plus 3 plus 4 is 9. When you add 9 plus 30, you have 39. And they say we should charge 30% on the profit for the year, and it will give us our tax. So we have arrived at 11.7%. 11.7%. So number 2, we determine the over or under provision. Do we have over or under provision? The prior tax provision was 5. Then we need to less the actual that was paid, which is 4. Let's go back to the question. Look at it. They said last year tax provision was 5 million, but the actual that was paid is 4 million, meaning that they provided. Oh, this is over provision. Sorry. Okay, look at it this way. So last year provision was 5 million, but the actual that was paid was 4 million. So 5 minus 4 will give you 1, meaning there was over provision of 1 million. Over provision of 1 million. So I made a mistake here. Please, you can quickly correct it. This is over provision, as it were, and not under provision. So we have over provision here of 1. Over provision of 1 million. So that is that for that. And then let's look at our deferred taxes. The deferred tax for the year. They said, let's go back to the question. The deferred tax for the year, I want us to look at it together. Yeah, see it here. They said the tax base of plant and equipment is 100 million, whereas the current amount as added is 3 years after the purchase of the asset is 120 million. They said the current year deferred tax liability rather, is 2 million. So we have been given that's the opening deferred tax. So, like I said, I put a note here. There's a note. You must always determine first if the deferred tax is a liability or an asset. I have told you before. When you are to calculate for deferred tax increase or decrease, please always know if the deferred tax you are considering is a deferred tax asset or a deferred tax liability. It will guide you to know how to appropriately, put the figure where they belong. Where you need to, remove from profit or loss, you will know. Where you need to add to profit or loss, you will know. And so the opening deferred tax is 2 million. Then the current year workings for. What is in workings for? Number one, they said deferred tax. Let's calculate this. Like I've told you, deferred tax is calculated by tax rate multiplied by temporary difference. The tax rate multiplied by the temporary difference. That is current, and the temporary difference is carrying amount minus the tax base. So we were told that the carrying amount is what? Let's look at it together. They said the carrying amount as a date is 120 million, whereas the tax base of the plant and equipment is 100 million. So 120 minus 100 will give us 20. Will give us 20, meaning that we have what we call a positive balance and a positive result. And I told you, once you have a positive result, what do you call it? It is called deferred tax liability. Please don't forget, when you have a positive result, when you less current amount from your when you less your current amount from the tax base, what you have, if it is positive result, it is known as a deferred tax liability. If it is negative, it is known as a deferred tax asset. So you must always multiply your temporary difference by the tax rate to get what is your deferred tax. So our deferred tax liability, when we multiply 30% multiplied by 20, it will give us 6. That is why we have what we call deferred tax liability. So this is the opening deferred tax is 2. Then the current year is 6. 2 minus 6 will mean that we have increase in deferred tax to be 4. And I told you, once you have increase in deferred tax, whether it is asset or liability, add it to current year provision. If it is decrease, less it from current year provision. So that is what we have done. Look at it here. Taxable profit 30, we have gotten those ones. So let's go to our determination of current year tax. Current year tax or current year provision, not tax as it were. Current year provision. Sorry, please. The current year provision is 11.7 million. And that is what we got from our calculation here. Look at it from our calculation here. Look at it here. 30 million was the current year profit that was declared. We had back all the non-allowable expenses, and that gives us 939. And then we charge the rate at 30%. We have 11.7. That's why we got this 11.7 million. And then we had, we are to less now. Sorry. So we are going to less our over provision. Less over provision. So when we less over provision, so let's jacket this. We have jacket D. So our answer now will be 14.7 will be our total tax expense for that period. So it's as simple as this. There is nothing, any question. You can check the question that I posted earlier. In fact, I will want you to attempt it by yourself rather than me solving. I may just walk you through them, but I will love that you, by the explanation that I've given in the first lesson under income tax, and then this second one, you should be able to at least attempt every of those questions conveniently. So, but let's go to the questions, and I will be explaining everything to you there. So the first one is oh, okay. Let's just okay. We'll look at the. Oh. Okay, so that is that for that. Please, I've uploaded other questions here. Please, I want you to go through them. They are not something that is difficult for you to do. I want to go through them, and then we can also have sessions together to look at each of these questions. Is it something that is difficult? I can as well solve it and send it to you, but I want to attempt every one of them. It's good for you to look at them, make mistake, and get back. Please look at them, and then we'll discuss much later. Thank you very much for your time once.